If you were born before 1958 and you are currently receiving Social Security benefits, there is a meaningful chance the Social Security Administration is sending you a smaller check than you are legally entitled to receive. Not because of a system error, not because of fraud, because of a filing decision made at the moment you claimed your benefits. A decision that most seniors made without understanding its permanent consequences that locked in a lower monthly payment for the rest of your life. The Social Security system contains several provisions specifically tied to birth year that change the calculation of your benefit amount, your full retirement age, your spousal benefit entitlement, and your ability to retroactively claim benefits for months you did not collect. Seniors born before 1958 sit at the intersection of multiple overlapping provisions, some favorable, some that were missed entirely at the time of filing. That together can mean a difference of $200 to $600 per month between what the SSA is currently paying and what the law says you are owed. This video covers exactly which provisions apply, who qualifies for a larger payment, and the specific steps to file a claim with the Social Security Administration before the window on some of these closes permanently. If this is your first time here, subscribe right now. Publishes new videos every week on the Social Security rules, tax strategies, and government programs that directly affect seniors and retirees. Free, plain English, no product to sell. Hit subscribe and the bell so you never miss a video that could increase your monthly income. Before I go further, I need to address two groups of people who are already assuming this does not apply to them. And both assumptions are wrong. The first group is the senior who filed for Social Security at 62 or 63, took the early reduced benefit, and believes that decision is permanent and irreversible. They are thinking there is nothing left to claim because they already made their choice. In many cases, that is incorrect. There are specific circumstances under which seniors who filed early can request a recalculation of their benefit. Circumstances tied directly to earnings records, spousal benefit interactions, and a provision called the earnings test adjustment that the SSA is required to apply automatically, but frequently does not apply correctly. If you filed early and your benefit was reduced, the question is not whether the reduction happened, it is whether the SSA applied every upward adjustment it was legally required to apply afterward. The second group is the senior who waited until full retirement age or later and believes they received the maximum benefit they are entitled to. Also, potentially incorrect. The SSA calculates your benefit based on your earnings record. Specifically, your highest 35 years of indexed earnings. Errors in Social Security earnings records are more common than most people realize. The SSA's own data shows that a meaningful percentage of earnings records contain inaccuracies, and an earnings record error that understates your lifetime income by even a moderate amount translates directly into a permanently lower monthly benefit. If you have never reviewed your Social Security earnings statement against your actual work history, you have never confirmed that your benefit was calculated correctly. I am going to cover both situations fully. By the end of this video, you will know exactly which provision applies to your specific filing history and the exact steps to take with the Social Security Administration to correct it. So why does the SSA send you a smaller check than you are owed without telling you? The Social Security Administration processes tens of millions of benefit claims using an automated calculation system. That system applies the rules it is programmed to apply based on the information in your file. It does not audit your earnings record for accuracy. It does not flag cases where a post-filing benefit adjustment was triggered but not applied. It does not send you a letter explaining that a provision exists that could increase your payment. It calculates a number, assigns that number to your account, and sends you a check for that amount every month indefinitely. The mechanism that creates the underpayment problem is straightforward. The SSA system depends entirely on the accuracy of your earnings record and the completeness of its own post-filing adjustment logic. When your earnings record contains an error, a year of income that was reported under a slightly different name, a self-employment period where Social Security taxes were paid but not properly credited, a period of employment where an employer failed to correctly report your wages, the system calculates your benefit on incomplete data and arrives at a lower number than the law requires. Similarly, when a post-filing adjustment is triggered by continued work after filing, by a correction to the earnings record, by a change in spousal filing status, the SSA system is supposed to apply the adjustment automatically. When it does not, the underpayment continues indefinitely. The agency does not proactively audit its own calculations. It relies on beneficiaries to identify and report discrepancies. Most beneficiaries never do because most beneficiaries do not know the adjustments exist or that they are entitled to request a recalculation. My name is Professor Kyle Pomello. I have spent decades studying federal benefit programs and the gap between what the law entitles American seniors to receive and what they actually receive after navigating a system that is not designed to maximize their benefit on their behalf. The situation that concerns me most in Social Security is not the senior who made a clearly wrong filing decision. It is the senior who made a reasonable decision at the time of filing based on incomplete information provided by an SSA field office that was focused on processing their claim rather than optimizing their lifetime benefit, and who has been receiving a lower payment ever since without any awareness that the calculation may have been based on an inaccurate or incomplete record. I have seen seniors recover months of retroactive underpayments after a single earnings record correction. I have seen spousal benefit recalculations add $180 to $300 per month to a payment that had been fixed for years. These recoveries do not require an attorney. They do not require a formal appeal in most cases. They require knowing which form to request, which record to review, and which specific question to ask at the SSA office. That is what I am providing today. Here is what we are covering in the next 20 minutes. I am going to walk through 4 specific provisions that disproportionately affect seniors born before 1958. The earnings record accuracy issue, the earnings test adjustment, the spousal benefit recalculation, and the delayed retirement credit verification. For each one, I will tell you who it affects, what the SSA is required to do, that it frequently does not do correctly, and the exact steps to request a review. Then I will add 2 bonus points covering the retroactive payment window, how far back you can recover underpaid benefits, and the 1 document you must request from the SSA before you can identify any of these issues on your own account. Point 1. The earnings record error, the most common source of permanent benefit underpayment. Step A. Bust the misconception. Most seniors assume that the Social Security Administration's record of their lifetime earnings is accurate because Social Security taxes were withheld from their paychecks for decades. The withholding was accurate. The recording of that withholding in the SSA's database is a separate process, and that separate process has a measurable error rate. The SSA itself has acknowledged in congressional testimony that its master earnings file contains inaccuracies affecting a significant percentage of accounts. Step B, the actual rule in plain English. Your Social Security retirement benefit is calculated using a formula applied to your average indexed monthly earnings, the AIME, which is derived from your highest 35 years of inflation-adjusted earnings as recorded in the SSA's master earnings file. If any year of your actual earnings is missing from that file, understated in that file, or credited to a different Social Security number due to a name change, a clerical error, or an employer reporting error, your AIM is lower than your actual work history warrants, and your monthly benefit is permanently reduced as a result. Common sources of earnings record errors include periods of self-employment where Schedule SE was filed, but the earnings were not correctly posted to the SSA record. Employment under a maiden name that was not reconciled when a Social Security card was updated. Employment during which an employer used an incorrect Social Security number on wage reports and military service earnings that were subject to special crediting rules that were not applied. Step C, dual group delivery. For the lower income senior whose benefit is calculated primarily on modest lifetime earnings, a single missing year of income in your SSA record can have an outsized impact on your benefit calculation because the Social Security benefit formula is weighted to replace a higher percentage of lower earners' income. A missing year that understates your lifetime earnings by $18,000 can reduce your monthly benefit by $40 to $80 permanently. Recovering that year through a corrected earnings record is worth $480 to $960 per year for the rest of your life, plus retroactive recovery of the underpayment. For the comfortable retiree with higher lifetime earnings, your benefit is calculated on your highest 35 years, and errors in lower earning years may have been displaced by higher earning years in the formula. The most impactful errors for higher earners are typically in peak earning years, the final 10 to 15 years of employment, where an employer reporting error or a self-employment crediting issue can meaningfully reduce the IME calculation. Step D. The catch. The SSA will not audit your earnings record on your behalf. The review is entirely initiated by you, and the window for correcting some types of earnings record errors, particularly those involving employer misreporting, can be limited by the availability of underlying wage records, which employers are not required to retain indefinitely. Step E. One action right now. Create or log into your My Social Security account at SSA.gov. Download your complete Social Security statement. Go to the Earnings Records section and compare each year's posted earnings to your actual income for that year using your tax returns, W-2s, or any other income records you have retained. Identify any year where the posted amount is zero, significantly lower than your actual earnings, or missing entirely. Write down every discrepancy. This list is the basis for your earnings record correction request. Point 2. The earnings test adjustment, the upward recalculation most seniors never receive. Step A. Bust the misconception. Seniors who filed for Social Security before their full retirement age and continued working are aware that the earnings test reduced their benefit. The SSA withholds $1 in benefits for every $2 earned above the annual earnings limit. What most of those seniors do not know is that when they reached full retirement age, the SSA was legally required to recalculate their benefit upward to credit them for every month their benefit was withheld due to the earnings test. That upward recalculation is supposed to happen automatically. It frequently does not happen correctly. Step B, the actual rule in plain English. Under Social Security regulations, when a beneficiary reaches full retirement age, the SSA must apply what is called an adjustment of reduction factor, a recalculation that increases the monthly benefit to account for months in which benefits were withheld due to the earnings test. The recalculation is proportional. For every 12 months of withheld benefits, the monthly payment increases by approximately 6.67%. For a senior whose benefits were withheld for 18 or 24 months due to continued work, this recalculation can add $100 to $250 per month to the permanent benefit amount. Step C. Dual group delivery. For the lower income senior who filed early and continued working part-time, the earnings test likely withheld benefits during your working years, and the upward recalculation at full retirement age should have increased your payment. If you reached full retirement age and did not notice an increase in your monthly benefit, the recalculation may not have been applied correctly. The SSA's own quality control reviews have identified this as a recurring source of underpayment. For the comfortable retiree who continued working after filing, the dollar impact of a missed earnings test adjustment is proportionally larger because your base benefit is higher. A missed adjustment on a $2,400 monthly benefit can represent $150 to $250 in permanently lost monthly income, $1,800 to $3,000 per year, plus retroactive recovery of the underpayment from the date the adjustment should have been applied. Step D. The catch. The SSA does not send a notice explaining the earnings test adjustment calculation or confirming that it was applied. The adjustment appears as a change in your monthly deposit amount, which most beneficiaries attribute to a cost of living adjustment rather than a benefit recalculation. If you filed early and worked during the benefit period, the only way to confirm the adjustment was correctly applied is to request a benefits calculation statement directly from the SSA. Step E. One action right now. Call the SSA at 1-800-772-1213 and request a benefits calculation statement that shows the earnings test adjustment applied to your account at full retirement age. Ask specifically, was an adjustment of reduction factor applied to my benefit when I reached full retirement age, and what was the amount of that adjustment? If the representative cannot confirm the adjustment or the amount, request an in-person appointment at your local SSA office to review your complete benefit calculation record. Point 3. The spousal benefit recalculation, the higher payment most married seniors are not receiving. Step A. Bust the misconception. Many married seniors believe their spousal benefit was calculated correctly at the time of filing and is fixed permanently. In some cases, it was not calculated correctly, and in other cases, a change in the higher earning spouse's benefit after the spousal benefit was established should have triggered an automatic upward adjustment that the SSA did not apply. Step B. The actual rule in plain English, a spousal benefit is calculated as up to 50% of the higher earning spouse's primary insurance amount, the benefit they would receive at their full retirement age. If the higher earning spouse's benefit was subsequently recalculated upward due to an earnings record correction, a delayed retirement credit adjustment, or a post-filing earnings recalculation, the spousal benefit should have been recalculated upward proportionally at the same time. When the SSA fails to apply the spousal recalculation automatically, the lower earning spouse continues receiving a payment calculated on the old lower figure indefinitely. Additionally, seniors born before 1954, a subset of the before 1958 group, were eligible for a filing strategy called restricted application that allowed them to claim only the spousal benefit while their own retirement benefit continued to grow. This strategy was eliminated for younger beneficiaries, but remains valid and available for those born on or before January 1, 1954. Seniors in this birth year group who did not use the restricted application strategy at the time of filing may have left significant lifetime benefit value unclaimed. Step C. Dual group delivery. For the lower income senior whose primary benefit source is a spousal benefit, the accuracy of that spousal benefit calculation is directly tied to the accuracy of your spouse's earnings record and benefit calculation. If your spouse's benefit was ever recalculated and your spousal benefit was not adjusted simultaneously, you are receiving less than the law requires for the comfortable retiree born before January 1, 1954. If you are still working or if you delayed filing for your own retirement benefit, confirm with the SSA whether the restricted application strategy was available to you and whether it was used. If it was not used and you were eligible, speak with a Social Security benefits counselor about what options remain available. Step D. The catch. Spousal benefit recalculations triggered by changes to the higher earning spouse's record are not always communicated to the lower earning spouse. The SSA's notification practices for secondary benefit adjustments are inconsistent, and the lower earning spouse may have no way of knowing the recalculation was required unless they specifically request a review. Step E. One action right now. Request a benefits verification letter from the SSA for both you and your spouse. Compare the spousal benefit amount on your letter to 50% of your spouse's primary insurance amount as shown on their letter. If your spousal benefit is less than 50% of your spouse's primary insurance amount and you filed at your full retirement age, request a formal benefit recalculation from the SSA in writing using Form SSA 795. Step A. Bust the misconception. Seniors who delayed filing for Social Security past their full retirement age know they earned delayed retirement credits, an 8% annual increase in their benefit for each year of delay up to age 70. Most assume those credits were automatically applied correctly to their benefit calculation. The assumption is generally correct, but not universally so, and the dollar value of a delayed retirement credit error is among the largest single-item discrepancies on any Social Security benefit statement. Step B. The actual rule in plain English. Delayed retirement credits accrue at a rate of 2/3% per month, 8% per year. For each month, a beneficiary delays filing past their full retirement age up to age 70. For a senior with a full retirement age benefit of $2,000 per month who delayed filing for 3 full years, the correct benefit with delayed credits is $2,480 per month. A calculation error that misses a single year of credits reduces that benefit by $160 per month, $1,920 per year permanently. Delayed retirement credit errors most commonly occur when a beneficiary's full retirement age was calculated incorrectly, when the delay period spanned a system update or administrative change at the SSA, or when the beneficiary had a period of suspended benefits that interacted with the credit accrual calculation in an unexpected way. Step C, dual group delivery for both groups equally. The delayed retirement credit verification is a straightforward mathematical check. You need three numbers: your full retirement age, your actual filing date, and your primary insurance amount at full retirement age. The difference between your filing date and your full retirement age expressed in months and multiplied by 2/3 of 1% gives you the exact credit percentage that should have been applied. Compare that to your current benefit amount. If the numbers do not align, you have identified a potential calculation error worth pursuing. Step D, the catch. The SSA's benefit verification letter shows your current benefit amount, but does not always show the underlying calculation components: the primary insurance amount, the credit percentage applied, and the resulting adjusted benefit in a format that makes verification straightforward. Getting the underlying numbers requires a specific request. Step E, one action right now. Contact the SSA and request a detailed benefit calculation breakdown showing your primary insurance amount, your full retirement age, your filing date, and the exact delayed retirement credit percentage applied to your benefit. Verify the math independently. If the calculation does not match, if the credit percentage applied is lower than what the filing delay warrants, submit a written recalculation request to the SSA using Form SSA 795 and attach your own calculation showing the discrepancy. Everything I just covered gives you 4 specific provisions to review on your Social Security account. What I am about to add is for the senior who identifies a discrepancy and wants to know exactly how far back they can recover the underpaid amount, and the one document they must obtain before any of these reviews are possible. Bonus 1, the retroactive payment window. How far back you can recover when the SSA corrects a benefit underpayment. Whether due to an earnings record error, a missed adjustment, a spousal recalculation, or a delayed retirement credit error, it is required to pay the corrected amount going forward and to recover the underpaid amount retroactively. The retroactive recovery window depends on the type of error. For earnings record corrections, the SSA will typically recalculate your benefit from the date you first became entitled to receive the correct amount based on the corrected record, for errors that have persisted for years. This can mean a lump sum retroactive payment covering the full underpayment period for missed post-filing adjustments, the earnings test recalculation, and the delayed retirement credit verification. The standard retroactive window is 6 months under SSA policy, though in cases involving SSA administrative error, the agency has discretion to extend retroactive payments further. Documenting that the error was the SSA's failure to apply a required adjustment rather than a beneficiary's failure to apply is the key to maximizing the retroactive recovery. Request your retroactive payment in writing. A verbal agreement with an SSA representative does not create a payment obligation. A written request with supporting documentation creates a formal record that the SSA must respond to and that can be appealed if denied. Bonus 2, the one document you must request before anything else. Before you can identify any of the issues covered in this video on your own account, you need one document that the SSA does not send automatically and that most beneficiaries have never requested: your complete Social Security earnings record and benefit calculation statement, also called a Social Security statement. You can access this online at ssa.gov by creating or logging into a My Social Security account. Once logged in, download the full statement, not the summary. The full statement includes your year-by-year earnings record going back to your first year of covered employment, your estimated benefit amounts at different claiming ages, and the primary insurance amount used to calculate your current benefit. Review every year of earnings against your actual income records. Look for years where the posted amount is 0, significantly understated, or missing entirely. Note your primary insurance amount and verify it against the benefit you are currently receiving, adjusted for any early filing reduction or delayed retirement credit. This document is the foundation for every correction request, every recalculation request, and every retroactive payment claim covered in this video. Get it before you make any calls to the SSA. Let me bring everything together with the one idea that runs through everything we covered today. The Social Security Administration calculates your benefit based on the information in its system. It does not audit that information for accuracy. It does not proactively identify cases where a required adjustment was not applied. It does not send you a letter explaining that a provision exists that could increase your payment. It sends you a check for the amount its system calculated, and that check will remain at that amount indefinitely unless you review the underlying calculation and request a correction. The seniors who receive the full benefit they are owed are not the ones who trusted the system to get it right automatically. They are the ones who downloaded their earnings statement, compared it to their actual work history, asked the SSA for a detailed benefit calculation breakdown, and filed a written correction request when the numbers did not match. That process takes a few hours. For many seniors born before 1958, it is worth $200 to $500 per month permanently, plus retroactive recovery of years of underpayment. Professor Kyle Pomelo's message for this channel is always the same. These systems process millions of accounts with automated calculations. The errors that occur are not malicious. They are systematic, and they correct themselves only when the person whose money is at stake knows what to look for and asks the right questions. You now know what to look for. Ask the questions. Before you close this video, do one thing. Send this to one person in your life who was born before 1958 and is currently receiving Social Security, a parent, a sibling, a neighbor, a friend. It does not matter whether they receive $900 a month or $2,400 a month. The provisions we covered today, earnings, record errors, missed earnings, test adjustments, spousal recalculations, delayed retirement credit discrepancies, apply across every benefit level, and the person you are thinking of right now has almost certainly never reviewed their Social Security earnings record against their actual work history. One review prompted by this video could recover thousands of dollars in retroactive underpayments and add hundreds of dollars per month to a fixed income for the rest of their life. That is worth more than almost any gift you could give. That is what this channel is here to do. In the next video, I am going to show you the one IRS form that eliminates up to $500,000 in capital gains tax when you sell your home. A form that your real estate agent will never mention because it is a tax document, not a real estate document, and that the IRS does not require you to file unless you have a gain above the exclusion threshold. Most seniors who sell their home never file it, and most of them did not need to pay the tax they paid. I will see you there.